In Chapter 11, we're going to just briefly discuss some of the calculations, some of the terminology that goes along with calculating federal income taxes. So, why are taxes obviously so important? Well, we need to have some information. We need to be able to make sure we take all the deductions that are permissible. We need to understand something about strategies. How can we minimize our tax liability? There are certain transactions, there are certain investments that have specific tax limits or rules associated with them. And of course, we need to be aware of those. And finally, in the end, anytime we make any kind of a financial decision, we need to have an understanding of the implications of taxation. So in general, to calculate individual tax, if I can make this just a wee little bit bigger, we can see that obviously you start off with gross income, and we'll describe some of these. We're going to make some adjustments to gross income. That gives us what's referred to as AGI, adjusted gross income. And AGI is a critical number to know for the calculation of certain deductions, itemizations, etc. There are deductions that we can take. They're either standard deductions or itemized deductions. We'll talk about those. Those are things that the IRS allows us to deduct because we do certain types of activities, if you will. Once then we find out income after deductions, we get exemptions. These are personal exemptions. So each person on a tax form gets an exemption. Your children count as an exemption. And depending on how old you are, potentially some disabilities, you also can take some exemptions for that. In the end, the idea here is that all of these things eventually lead us to taxable income. You figure out the tax, and then you determine whether we have tax credits. These are, again, sometimes just transactions, certain events that happen in our lives, but the government allows us to reduce our tax burden dollar for dollar based on these credits. So let's think about which would you rather have, a tax credit or a tax deduction? And in the end, you'd rather have a tax credit because it reduces taxes dollar for dollar. The itemized deduction only reduces taxes based on your marginal tax bracket. So in the end, we'll find out what your total tax due is. So next, how do we calculate gross income? Well, there's two primary kinds of income that we're going to incorporate. Earned income is your salaries from W-2s and 1099 kinds of income. And of course, there's portfolio income. We have interest, dividends, and of course, we have capital gains and losses. Now, we're going to talk a little bit about capital gains and losses because they have special rules. But that is, in general, what most people have as gross income. We're also going to add another kind when we get down a slide or two that's referred to as passive income. But essentially, this income is all added up. It shows up on the 1040, the front page of the tax form. We then go through our adjustments to get to AGI, or adjusted gross income. So what do we need to know about capital gains and losses? Well, there are short-term and there are long-term losses. Long-term losses or long-term gains are taxed at a current maximum rate of 15%. So when you sell an asset, you get to write off, or you will be taxed once we net these together at a maximum of 15% is the gain. Now, there are two special kinds of rules that go along with this. One is a wash sale. And basically what a wash sale is, says you can't take a loss on an asset today and then replace it with a similar asset within 30 days prior to or after that sale. So it's 61 days. So let's say you have a today you decide you want to you're going to sell a bond that you have a loss on, and you lost $300 on this bond. It's the XYZ bond. Well, you can't then go out and buy the XYZ bond tomorrow as another investment, because you have to wait 30 days after or 30 days prior to the sale. What this does is it says, well, because really nothing happened. You sold and bought the exact same asset in the same day, so your portfolio didn't change. So these wash sale rules are going to let us work with, if you will, the losses, and not take losses when you shouldn't be taking them. Capital gains and sales on a residence, if you're married filing joint, $500,000 of profit is tax-free. This could even include a vacation home, and this amount of $500,000 renews every 2 years. So every 2 years, if you sold your house at a profit, you could take that profit tax-free, again, every 2 years, up to $500,000. Now, what happens like now, where a lot of people are selling their homes at a loss? Well, they don't get a deduction. There's no capital loss for the sale of a residence. So you get taxed on the gains, but you don't get to take advantage of any losses. How the ultimate capital gains tax calculation works is we segment our gains and losses into long-term and short-term, and then we net them. So then you're going to have the net long-term gains or losses, and then you have short-term. So now we're down from, we had some gains, we had some losses. We had some gains, we had some losses. Now we just have two numbers. It's either a gain or a loss on the long-term side and a gain or a loss on the short-term side. We then net them together. So in the end, you're going to have a net capital gain, and it's either going to be net long-term or it's going to be net short-term as far as gains or losses. If you have a net long-term, short-term gain, it's going to be taxed as ordinary income. But if it's a net long-term capital gain, it's going to be taxed at the long-term gain rate, which is the maximum of 15%. But what happens if you have a net loss? Well, you're allowed to write off only up to $3,000 of the losses. Once you've taken or maxed out that $3,000, any balance is going to be carried forward into the next tax period, so that you could possibly offset future capital gains and losses. I'd mentioned this passive income concept. Passive income has to do with things like tax shelters. You can only offset passive gains with passive losses. That is, they can't be moved into to help reduce the other ordinary kinds of income we talked about, which was your ordinary income or your portfolio income. Now, the things that are part of this are essentially things like tax shelters. So you have real estate properties that are rental properties. You have oil trusts, passive types of investments in companies like limited partnerships, etc. But in real estate, there is an exception. If you're a small investor, you don't make a lot of money. That is, if your AGI is less than $100,000, and if you own at least 10% of the real estate and make decisions about it, then you can use up to $25,000 of losses to offset regular income. But other than that, all of this income is then netted and added into your tax, into the taxes. Miscellaneous types of income that you can have taxes on, tax-exempt income from municipal bonds. Typically, you don't pay federal taxes. And in fact, if you buy municipal bonds from the state in which you live, there's no federal or state taxes. Social Security income might be taxable, depending on how much income you make. And then there is always what we refer to as non-taxable income. A gift that you receive from somebody else is not taxable. If you receive death benefits, if you receive an inheritance, all right, those death benefits are not usually taxable unless you had some form of ownership in those assets. That's really this non-taxable income is really more of a topic for discussion when we get to the estate planning chapters. So how do we look at this deduction for real estate losses? Here we have a person has $70,000 in wages. They have a limited partnership of $3,000, and they own and operate a real estate investment property that generates the following tax loss. Their real estate property loses $5,000 in this past year. So I can use this $5,000 to offset this $3,000 from passive activity, and then the remaining $2,000 left over can be moved forward into offset my ordinary income. Now, things change if I earn more than $100,000 in AGI, or if this total amount exceeds $25,000.